Our next guest says we could easily see a reacceleration of inflation next year. Joining us now is Kathryn Rooney Vera, who's a chief market strategist at StoneX. Kathryn, great to have you with us. So the energy piece really kind of throws a spanner in the works, doesn't it? Should we be assuming that the possibility of a soft landing or a no landing whilst achieving the Fed's inflation goal is looking a lot more challenged right now?
Well, it certainly is, Heidi, with the resurgence that we've seen in the price of oil. And I think you can also see that expectation being unwound of, the Fed cutting pretty aggressively and soft landing and kind of this whole wonderful, beautiful, rosy picture all panning out for 2024. And you can see that in the appreciation of the dollar, none of which is good, of course, for the emerging market space. So I think going into 2024 to really get inflation back to that 2% target, the Fed is at least going to have to hold for an extended period of time rather than cut, which means that the dollar probably has a bit more upside. And returning to the EM space, which I think is what you focus on your show, is that the worst scenario for the emerging markets is with a high Fed funds rate, a strong dollar, and potentially the U.S. sliding even into recession. So 2024, I think, is going to bring a lot of difficulty, tumult, and I think investors would be wise to engage in what I call counter-cyclical portfolio policy at this juncture.
How are you positioning then at this point?
For people that have not had defensive equity positions, I like them. Staples, healthcare, energy has been one of my top picks this year. I think that makes sense in terms of the equity space. Utilities as well. I like cash. I mean, the short-term tips are attractive. I think the market is buying into this idea wholesale for some period of time of a no landing scenario, which reality bites. I mean, when you look at historical probabilities, the probability of landing this no landing or soft landing scenario is historically low. So I think that it would behoove investors to buy put protection on their technology holdings, for example, when volatility is very low and puts are cheap, or they have been for the past month. Hold some cash, hold some gold, get into the defensive sectors, and look at the tip option, because the fact is that if you look at real yields versus nominal, the markets continue to price this benign inflation scenario going into January of 2025.
We saw also this year that consumer discretionary stocks actually returned double the broader S&P. Does this mean that we should be really turning away from consumer-facing stocks then?
Yes, if you get a downdraft in consumer demand and you get this story play out, which I think has a higher than discounted probability, which is that the Fed stays on hold for a much longer period of time than is currently discounted. That's going to be bad for the consumer, especially if you get what we're already seeing is a rollover in the labor market. So what keeps consumer confidence high? People have jobs and they're earning wages that finally, in a couple of recent data points, are above inflation. So real income's positive, 401ks are looking pretty good. People have jobs or they can get another job in another way. Once those things change, you get a drop in consumer confidence. And I think those interest rate sensitive sectors, such as consumer discretionary, such as tech, could see a retracement going into next year.
Yeah, we continue to see NASDAQ futures attracting bearish flows. What about the IPO market? Could we see more activity after the healthy debut of ARM? Today we had Instacart also jumping 12%.
Yeah, I mean, well, right now everything is looking still pretty rosy. I think that going into next year, though, the tables will turn. And I think there's going to be a lot more risk aversion. As I say, the Fed holds for an extended period of time. So if I'm right and we get 550 in terms of the terminal rate and a soft landing, that means that the Fed is probably going to have to increase rates rather than decrease rates. Because my view is that going into the next 24 months, the Fed is going to have to face a decision between 2% inflation or breaking something, and specifically consumption.
Kathryn, are you concerned and factoring in a potential government shutdown later this year?
Well, that's certainly going to play into risk-off appetite. I think that the other thing that very few are talking about is, of course, the fiscal situation and elections coming up next year with the fiscal deficit at around 8% of GDP, a little bit higher. So that in and of itself is inflationary. When you combine that with the prospects of the markets retracing or taking back its more bullish view with regard to the prospect of Fed hikes, the impending government shutdown, which I think is going to happen, then I do think it makes sense to protect those long risk positions and make your portfolio more defensively positioned.
Kathryn Rooney Vera, great to have you with us, Chief Market Strategist at StoneX.